the world's first cryptocurrency news center on Daily.
Welcome to Crypto Nation TV. I'm your host, Jamie Fora. Each week, we bring you the top cryptocurrency-related news from around the world. Now, for people familiar with cryptocurrency, this news carries a significant amount of interest and helps them stay current on the events that drive what many now consider to be the biggest financial phenomenon of our lifetime. However, if you're brand new to cryptocurrency, much of the news that we report may not make a lot of sense to you until you have a basic understanding of what a blockchain is, what cryptocurrencies are, and how these technologies are changing the global financial marketplace. So in order to help you get up to speed quickly, in this video we're actually going to cover the basics of cryptocurrency, including a brief history of how cryptocurrencies came into existence, some common terms and concepts, and of course, and some of the most important digital assets available today. Make no mistake, there's a ton of hype in this market right now, both positive and negative. There are plenty of naysayers that will point to the fact that criminals have used Bitcoin as a tool in various criminal enterprises, but that's also true of other forms of money. It's true of houses, weapons, vehicles, the internet, nearly any other widely used tool. So this argument is pretty baseless. Naysayers have also noted many times that Bitcoin and other cryptocurrencies, for that matter, are extremely volatile and are prone to cycles of booms and busts. But let's not also forget that anytime a new groundbreaking technology emerges, the hype that results in the market inevitably creates a bubble that, of course, is going to burst. Take the dot-com bubble, for instance. This is just another instance where hype drove the markets up too quickly, and that was followed by a crash. But while some of the offerings were valueless, and investors, of course, lost money in those projects, the market for internet-based businesses actually grew even stronger following the crash. Now, some of the biggest companies in the world, like Google, Amazon, and Facebook, are tech companies whose focus is on internet-based technology. Look, speculators and traders, they're going to run prices up and down in the markets. That's only natural. And it's also interesting and fun to follow, and we'll keep following that each and every day. But make no mistake, there are far more valuable technologies that are emerging from the innovation than the speculative trading could ever accurately reflect. This market is just getting started, and it's crucial to develop an understanding of how it works so we don't fall behind and miss opportunities. First, let's go ahead and define cryptocurrencies. Perhaps the easiest way to think about a cryptocurrency is that it's really nothing more than a snippet of computer code which informs a decentralized software application, or DApp, how to treat the information held within that code. In many cases, the code simply represents a unit of value, so the holder of that code is credited with a certain number of units of the currency. In other cases, the code for a cryptocurrency is written a little differently in order to function within the requirements of the decentralized application for which it was built. Theoretically, the demand for DApp's service is what will be the basis for the value of a cryptocurrency that goes with that DApp. But of course, as with anything of value, the relationship between the demand and supply are also being evaluated by investors. Quite literally every single second of every single day, a battle is taking place at the cryptocurrency exchanges as the market attempts to determine the value of each digital asset. Now, before we get into any of the specific assets and what they do, we need to take a step back and take a look at the events that led to the creation of cryptocurrencies. When we come back from the break, we're going to take a look at the financial crisis of 2008 and how it led to the creation of Bitcoin, the world's first cryptocurrency. We'll be right back.
The world's first cryptocurrency news center on Daily.
Welcome back, and thanks for joining us. Now, before the break, we defined a cryptocurrency as a snippet of computer code which informs a decentralized software application, or DApp, how to treat the information held within that code. Because cryptocurrencies are computer code, they have the ability to offer a variety of unique functions, just as any software does. But for the purpose of establishing a basic understanding, let's start with the original function of cryptocurrency, which is to act as a digital, tradable asset like a currency. And to understand that, we'll start by looking at the first cryptocurrency, which was Bitcoin. Now, you may be asking, why does anyone even need a new currency when we already have the money that our government created for us? And maybe you think that our current monetary system works just fine. But in order to understand why cryptocurrencies exist in the first place, we need to go back to the year 2008 and the financial crisis that started in the US and sent shockwaves throughout the rest of the world. In the years leading up to the financial crisis of 2008, the world's largest banks were heavily investing and trading in highly risky derivative products known as mortgage-backed securities. Sometimes you'll see this MBS. Mortgage-backed securities were essentially investments in bundled mortgage debt. That means that thousands of people's mortgages were pooled together into a single investment product, and investors could then invest in that product with the hope of making a return on the combined interest generated from those mortgages. Now, that in and of itself is not where the problem was. The problem was that these assets were inaccurately valued based on questionable credit rating reports from agencies that may have been pressured to give favorable ratings. Now, how were they pressured, you might be asking? Well, the issuers of those mortgage-backed securities were the companies that hired the ratings agencies, and of course, they wanted the best ratings possible so they could sell the mortgage-backed securities at the highest rates possible. This put the ratings agencies in a position where it could be possible for them to get more or less work depending upon the outcome of their ratings report. So what do you think happened? Well, there's clearly a conflict of interest here. And we now know that the MBS packages received overly favorable ratings, which understated the real risk in these investments. Now, while all this may seem a bit convoluted, the real takeaway here is that the major banking institutions were basically gambling with massive amounts of the people's money based purely on a system of trust. Once the cracks in the system began to reveal themselves, people naturally began to question whether or not they could trust the banks at all. And when the U.S. government used taxpayer funds to bail out those banks, many people became furious. Coupling these events with the ever-decreasing buying power of the dollar since the removal of the gold standard, as well as the massive and rapidly escalating U.S. debt. And there are plenty of reasons why people in the U.S. have begun to lose faith in the traditional financial system. And this is not just happening in the U.S. Governments around the world are racking up massive debt, just like the U.S., and people around the world are beginning to grow concerned. Now, this has paved the way for an ever-expanding acceptance of a new trustless system. Now, keep in mind the term trustless is used very frequently with regard to cryptocurrency, but it does not mean untrustworthy. Actually, it means that trust is not required at all because a system has been developed that is not dependent upon the trust in any human being. In essence, a trustless system is one that is supposedly not corruptible. Okay, so moving on. In late 2008, an anonymous inventor using the alias Satoshi Nakamoto released a peer-to-peer electronic cash system that we now know as Bitcoin. Keep in mind, digital or electronic cash is not a new concept. In fact, economists estimate that less than 10% of all the world's money is actually printed currency. The rest exists purely in the form of, in the digital realm, on the ledgers of banking institutions around the world. So Nakamoto's invention, Bitcoin, is an electronic cash system that differs from the typical banking system in three unique ways. First, the system works on a peer-to-peer basis, meaning that I can send you money directly to you with no banking intermediary. Now, that's not the same with it's not the same thing as Venmo or Zelle. You've heard those terms, I'm sure, before. Those systems require banking. With Bitcoin, if you have a digital wallet that can send and accept Bitcoin, you have complete control of your own Bitcoin and function as your own bank. Number two, the system is decentralized with no central server or central authority that can be corrupted. Instead, the ledger system is encrypted and held on the network of servers. These servers are each hold a copy of the ledger system, and all the servers which are part of this network must agree with each other. And number three, the encryption process is so advanced that in theory, the encryption cannot be reverse engineered and hacked, thus ensuring that no single entity could change the ledger. Now keep in mind that Bitcoin has never been hacked. This encryption solved a problem known as double spending. What this means is that if a network of computers, each controlled by unrelated parties, must all compare their copy of the ledger and then agree on the accuracy of the transactions on that ledger before permitting a new transaction, it becomes incredibly difficult to cheat that system. That is a system of consensus that does not require trust in any single entity. In short, this meant that any holder of a Bitcoin could be the only holder of that particular Bitcoin. Now, this may all sound a pretty obvious requirement for any digital money, but this was a problem that had not been solved before the invention of Bitcoin. In fact, without a decentralized ledger, it's simply not achievable. And so we're at the mercy of our banking institutions to maintain a proper and accurate record of our money. Now that we have a basic understanding of what Bitcoin is, we need to understand a bit more about how this ledger system works. So, as we discussed, every cryptocurrency requires a network of peers, and every peer has a record of the complete history of all transactions, and thus the balance of every account. A transaction on this network is simply a file that says Jim gives X amount of Bitcoin to Jane. This transaction is signed by Jim's private key. After signed, this transaction is broadcasted in the network, sent from one peer to every other peer. The transaction is known almost immediately by the whole network. However, that transaction has simply been added to a block of transactions. And now that block needs to be confirmed in order to be added to the chain of blocks, which is aptly called, you guessed it, blockchain. Now, you may have heard the term mining before in reference to cryptocurrency. This is where the process of mining comes in. We've covered quite a bit so far, so let's go ahead and take a quick break and digest what we've learned. And when we come back, we'll dig into how the blockchain works, what mining is, how mining works, and why it's profitable. We'll also discuss some problems with mining and some of the solutions that are being developed as we speak. Stay with us.
Crypto Nation TV, the first and only global televised crypto and blockchain news station. We cover the latest trading action with news and insight into how the markets are performing and what's moving them. We give you the scoop on the hottest conferences coming to a town near you, with interviews from top crypto and blockchain industry leaders and live coverage of events that are shaping the industry, bringing you the market analysis you need to make an informed decision so you can approach the markets like a pro, and keeping an eye on the governments from around the world as they scramble to figure out how to deal with the amazing crypto phenomenon. Crypto Nation TV is your one-stop shop for all your crypto and blockchain news and analysis, with around-the-clock coverage of the issues that impact the market. Visit CryptoNationTV.com to get the app today. The world's first cryptocurrency news center on Daily.
Welcome back. Now, just before the break, we explored the origins of cryptocurrency and briefly touched on the blockchain and on mining. Now, just to quickly recap, a blockchain is a software application that's required to operate on multiple computers. The main function of that software is to maintain a tamper-proof digital record of information and to call upon the computers in the network to verify the entire record before permitting new information to be added to the record. So if I wanted to send Bitcoin to you, the entire record of who owns which Bitcoins must be confirmed before a new transaction from me to you can be permitted. That way, I can't send you Bitcoin that I don't actually own. Let's say I just want to send 5 Bitcoin to you. You'd simply send me the public address of your wallet so I would know where to send it. Your public address is just a series of numbers and letters unique to your wallet. So I would simply log into my wallet or exchange, and then I'd enter your address and the amount I wanted to send. That's right, actually, I can actually send from an exchange or a wallet. If you want to learn more about wallets, be sure to head over to the education section of our website. We've got a whole write-up on wallets there. Once I submit the transaction, it's added to the next block of the transactions in the queue, and then we simply need to wait for the miners to confirm the record on the blockchain to cement the transaction into perpetuity. Now, this doesn't take days like a wire transfer, but depending upon the cryptocurrency, it can take several minutes. Right now, a Bitcoin transaction takes about 10 minutes to be confirmed. On other cryptocurrencies, some of them are actually considerably faster than that, but we'll dig into that after we explore the mining process. Now, miners are computers that run the software that can confirm transactions. Miners take transactions, confirm their legitimacy, and distribute the confirmed record to the entire network of nodes that maintain the ledger system. You're probably wondering how miners confirm transactions and whether or not they can be manipulated or hacked and so on. Well, let's start with how mining works in Bitcoin. Satoshi Nakamoto established a process whereby the mining computers would need to invest some of their computing power, each of them, to qualify for this task. Each mining computer must race to be the first to solve a cryptographic mathematical problem in order to find what is known as a hash. The hash includes an encrypted record of the preceding block. So when a mining computer solves this encrypted puzzle, the mining computer has verified the record of the blockchain without having the ability to alter the record. This hashing process adds security to the record while also linking the new block with the preceding block. This process, whereby all the computers race to solve the problem, is called proof of work. And for Bitcoin, it requires a lot of work. In fact, it requires supercomputing that involves expensive, powerful mining computers known as ASIC miners that most people can't afford. This supercomputing process adds security and stability to the network. It also requires an immense amount of electricity. So much, in fact, that some reports list Bitcoin energy consumption ahead of 159 combined countries. During the height of the market, the daily growth of energy consumption by Bitcoin mining was estimated at approximately the amount of energy that the nation of Haiti uses in an entire year. With each new block confirmation, the cryptographic puzzle gets even harder to solve. and the amount of computing power increases and requires more energy. So there are obviously some major issues that need to be addressed in this mining process. However, new variations of the blockchain consensus mechanism are being implemented by other projects that many believe are vast improvements over proof-of-work-based mining, while also maintaining a credible consensus and ample security. Proof of stake, for instance, is a protocol that differs from proof-of-work mining in the following ways. First, participants who hold coins have a stake and can verify transactions. Second, no supercomputers are needed. Instead, a basic home computer can act as a node, allowing anyone with a computer to verify transactions and earn rewards. And third, smaller groups of nodes can verify the transaction as opposed to the entire network, as long as consensus is reached and the transaction is authorized. Now, because of these different transaction times, the fees of those transactions are vastly reduced and energy consumption is reduced at an exponential level. Projects like Neo and Stellar already use this protocol, and other current proof-of-work-based projects like Ethereum may soon switch to a proof-of-stake-based process. And I'm sure you're wondering, what's the incentive for mining or staking? Well, in the case of Bitcoin, for instance, each time a block is confirmed, new Bitcoin is minted. The miner who wins the race to confirm the block receives newly minted Bitcoin, and this can amount to a significant amount of money as Bitcoin prices remain high. Right now, the winning miner receives 12.5 Bitcoins when it confirms a block. At the time of recording, Bitcoin's at about $3,500, so we're talking about a reward of nearly $44,000, and that's a pretty significant reward. Over time, however, the reward diminishes through a process called halving, whereby the block reward is cut in half. When Bitcoin was created, the block reward used to be 50 Bitcoin. And as we mentioned, it's now down to 12.5. This decrease in block reward means that over time, less and less new Bitcoin are created, which, combined with a theoretically increasing demand, would theoretically keep pushing Bitcoin's price up over a long period of time. Now, it's important to keep in mind, though, that when the block reward has been halved 64 times, the block reward will be down to a fraction of a Bitcoin. Many people believe that this too poses a problem for Bitcoin, as miners will have to begin charging substantial fees in order to cover the energy consumption costs, and that would certainly not make Bitcoin a currency that is viable for small transactions, often referred to as micropayments. While Visa claims it can process 24,000 transactions per second, Bitcoin can only transact 7 times per second. And because of these factors, you'll hear Bitcoin advocates calling Bitcoin, quote, digital gold, to convey that Bitcoin is intended as a store of value as opposed to a transaction-friendly currency. That said, recent projects like the Lightning Network can increase transaction times, reducing transaction costs and reducing energy consumption, all while using the Bitcoin blockchain. Now, regarding this proof-of-stake consensus mechanism and projects that are based on that, stakeholders who verify transactions are also paid an incentive, but it typically comes in the form of a smaller transaction cost. We'll follow the various proof-of-work and proof-of-stake improvements and report on them in our regularly scheduled news programs as they develop. What's perhaps most important to take away from all of this is that despite the issues we've noted here, Bitcoin has demonstrated that humanity can utilize technology to transcend governmental controls over our system of transacting with one another. Famed entrepreneur and early Bitcoin adopter Eric Voorhees called this, quote, the separation of money and state, end quote. Bitcoin opened the door to an emerging trustless digital asset class, and one that's growing rapidly. One thing is for sure, this market's just getting started. And when we come back, we'll take a look at another way that blockchain is being used and other projects that are changing how humans interact with one another. Stay with us.
The world's first cryptocurrency news center on Daily.
Welcome back to our cryptocurrency basics edition of CryptoNation TV. Now, for those just joining us, before the break, we explained that Bitcoin is really just a snippet of computer code that informs a decentralized application, how many units the code represents, and what wallet it belongs to. Pretty simple. Remember, a decentralized application is just software that's held on a bunch of different computers and requires the consensus of those computers in order to properly function. Sometimes you'll hear this referred to as distributed ledger technology. Now, the way that this ledger functions is that it assembles transactions into blocks and requires all the mining computers on the network to race to solve a mathematically encrypted puzzle that holds data from previous transactions within the puzzle, thus verifying the record of transactions held by the computers on the network, thereby verifying the chain of blocks or the blockchain. The invention of Bitcoin was itself revolutionary. However, in 2014, a brilliant 19-year-old programmer from Toronto dreamed up a new platform based on blockchain technology that would transcend the financial use cases for Bitcoin, and that, he hoped, would entirely transform the entire internet. Now, the system was called Ethereum, and rather than operating a set of limited operations like Bitcoin does, Ethereum is a blockchain-based platform that allows developers to create whatever operations they want on the Ethereum network. This means developers can build thousands of different decentralized trustless applications on the platform without having to develop an entirely new blockchain each time. This concept opened doors to new technologies that go way beyond anything we've seen before. And it opened the floodgates of investments through what are referred to now as initial coin offerings, or ICOs. An initial coin offering is a type of crowdfunding using cryptocurrencies to raise capital. An ICO is a quantity of the crowdfunded cryptocurrency that's sold to investors in the form of tokens, in exchange for government-issued money or other cryptocurrencies such as Bitcoin or Ethereum. Now, these tokens are promoted as future functional units of currency, or if or when the ICO's funding goal is met and the project actually launches. Now, ICOs provide a means by which startups avoid costs of regulatory compliance and intermediaries such as venture capitalists, banks, and stock exchanges. Because of this, ICOs may fall outside the existing regulations depending upon the nature of the project, or are banned altogether in some jurisdictions such as China and South Korea. At the very minimum, ICOs have fallen under scrutiny of dozens of regulatory bodies around the world, and now significant efforts are being initiated around the world to rein in this form of crowdfunding. Despite these efforts, ICOs have managed to raise an incredible sum of cash, with projects like Telegram and EOS each raising billions of dollars. A new major development happening now is the rise of security token offerings. These are tokens which are compliant with regulatory requirements. In the future, we may even see publicly traded companies creating security interests just like stocks, but issued as digital assets just like cryptocurrencies, and then offer these investments in any number of different types of ventures. Perhaps we'll see a world where people transact with one another by sending various forms of security tokens to one another in exchange for homes or cars or even services for that matter. And while ideas like that may seem like a distant possibility, it's already actually happening among primarily software developers who are advancing projects in this space. It may only be a matter of time before this takes off in a major way. For now, there are speculators and naysayers hyping both positivity and negativity about the future of this technology. Once the hype dies down and the market matures, there will be even more innovation to look forward to. Well, unfortunately, that's all the time we have. I hope you found this video helpful and informative. And more importantly, I hope it makes the news that you'll be seeing in the future that much easier to understand. If you found it helpful, please be sure to share it with anyone that you think might find it interesting. Now, for more information on the thousands of innovative projects happening now, please be sure to check out the markets page of our website too for current pricing and summary pages of each of the currently active traded digital assets available on the various exchanges. I'm Jamie Fora. Thanks so much for watching.
Crypto Nation TV, the first and only global televised crypto and blockchain news station. We cover the latest trading action with news and insight into how the markets are performing and what's moving them. We give you the scoop on the hottest conferences coming to a town near you, with interviews from top crypto and blockchain industry leaders and live coverage of events that are shaping the industry, bringing you the market analysis you need to make an informed decision so you can approach the markets like a pro, and keeping an eye on the governments from around the world as they scramble to figure out how to deal with the amazing crypto phenomenon. Crypto Nation TV is your one-stop shop for all your crypto and blockchain news and analysis, with around-the-clock coverage of the issues that impact the market. Visit CryptoNationTV.com to get the app today.